Okay, you can go ahead now, sir. You can go ahead.
Okay. So now I said I want to give us just a tip on if you want to know whether you are ready, whether you want to pass this diet or not. There are some questions you should ask yourself. I don't know if it was in this class or it was in another class we did risk and risk management. I think we discussed risk also yesterday, right? Was it yesterday? Or probably
No,
the
that was in PM class.
yeah, PM. So now, if you're looking at what can make you come to class, what can make you attend classes and still fail. So if I ask you a question, do you know your exam dates? Does anyone know the exam dates?
No, sir.
You don't know the exam date yet. And you came to write ICANN. You don't know when your exam date is. Eh? Those who will be writing November diet 2027, I can give you their dates today. It's just for me to
Maybe
open
the
my
third
calendar
week, maybe
and
the
I'll
third week
tell you
of the
when the
November.
date.
Third week of November.
Yes, third week of November is the exam. Now, if the exam is third week of November, when do you start? When do you plan to start reading for the exam? Like reading on your own, not coming to class, not attending any lectures. When do you intend to start reading on
Beginning
your
of
own?
next month.
Beginning of next month. You are sure about that, sir?
Yes, sir.
Okay. Now, when do you intend to end all classes, all tutorials? So there is this notion from students that if I attend classes very well, I'll pass. Can I tell you one truth? You will attend classes very well and you will still not pass. Because passing the exam is not in the class, it's in your hands. Why do you think undergraduate students will attend classes Monday to Friday, all lectures back to back, and on the exam day, you will see fail and have carryover? Some will even have spillover. Why do you think they fail? Is it that they don't attend classes? No. See, when you don't have enough time to read, when you don't create time to read, then it means you are not ready for ICANN. I used to tell people who are preparing for exams, some people will say that if you ask some people, why did you not start ICANN exam all this one? Or why are you just starting? They'll tell you it's money. But I'm telling you it's wrong. What you need for ICANN exam, the first thing you need is not money. The second thing you need is not money. The first thing you need is God. Let God be aware that you want to write ICANN. And you commit your journey into God's hands. You see, after committing your journey into God's hands, the next thing you need is time, not money. A lot of people think, it's because of money that I have not started my ICANN. And I used to ask those people, if you see the money today, what's the level of assurance that you will write ICANN today and you will pass this exam? If you write this ICANN exam today, you will pass. What's the assurance? That's when you will know that the issue you are having is not money, it's time. I don't know if you understand me. Now,
Perfect, sir.
no
I think I
matter, no matter how many times you come to class, you need to sit on your own, read, solve questions on your own. You agree with me that there are so many things that you think you know until you start working on it by yourself, until you start solving it. Go back to your mathematics period, whereby I understand this thing when the man was taking it now. How come I don't understand anymore? How did he get this one? Oh, how did he get this one? Oh, you'll be thinking. Your brain is there to work for you. But your brain has the capacity to expand itself. The more you use your brain, the more it works for you. Your brain has no limit, though. You can be tired, you can be exhausted. But the more you use your brain, the wider it becomes. So please, today is Saturday, right? I'm not talking for SBR only. You have so many other courses. If you think you want to wait till next month, your next month will become next month. From next month, it becomes another next month. Next month will become another next month. Do you understand? Then to now get to, when you now get to October, you now realize that I cannot take 5 papers. Let me take 3. Let me take 2. Whereas your initial plan was to take 5. What do you think happened along the way? You don't have time. You recreate that time. Do you understand? Yes, you create that time. When I was writing my own icon, Mr. Ibrahim is my weakness. I was in school then. And me, you can't be as busy as I am. Because as at then, I was into politics. I was doing departmental politics, faculty politics, SUG politics, right? I was taking ATS students. I was taking my fellow ICANN students. I was taking ND1 and the 2 students. I was taking HND1 students, even before I got to HND1. Do you understand? Now, all these things were the things I was doing, and yet I had time to go and read. I did not attend any ICANN tutorial center. My skills are professional. There is no ICANN tutorial center that can take the credit that this guy registered in my center. Nobody. All we needed then was to read. We formed partnership. We made friends who are colleagues, who had like minds. All in all, I'm just asking you to start reading. If you don't have friends you read with, start getting them now. Many of you on this call, you don't know each other from Adams. You've never met each other. In fact, you might not even see each other again. You might not meet. Many of you are passing beside each other and you don't know. There's another center where I teach. I was taking my students, I was taking in that class yesterday. And I was telling them about transitioning into an online class. And one of them asked me, what about calculation? I told that person that if you attend my calculation class, you will stop attending physical class. One of them in that class said, yes, you are right. I attended your FR class last diet. I said, where? He said, next gen. Apparently, this student was in my class last diet, physical class, taking them other courses. Whereas he was on next gen as well. She, a female, she saw me on next gen. She did not say anything until yesterday. So you can imagine so many other people that are on this call that we've never met before, and we might not even meet till thy kingdom come. A very good example. When was the last time I met Mr. Ibrahim? Someone that we're meeting every day while we're in school. Someone that we're meeting almost every week when I first came to Abuja. But now I've not seen him in years. I don't think I've seen him since 2022.
Yes, sir. You've not, sir.
So there are so many people like that, but try to form that partnership, mix with people, read. The only thing that connects me and Mr. Ibrahim after all this while is ICANN. You need to start reading. If you can read alone, start reading alone. Ask questions. I've not received questions from any of you. A DM, sir, this thing you taught us yesterday, can you please explain this line? I've not seen a student that will challenge me. I've not seen a student that will make me go back to library. Do you understand? Please, all this is just for us to start reading. Okay? So please, I'm begging you, we might not have another time to discuss this, but please, all right? So that will be that. The person who gave us what he gave us earlier, thank you for that. We truly appreciate. Now, today we are looking at, I think we did chapter 6 yesterday, right?
Thank you so much, sir, Mr. Razak. I think I just need to come in just a minute, sir. Please permit me to just use a minute, just a minute.
Go ahead,
okay, thank you so much. And I want to go back to your word that you said, you don't need money to start ICANN. It's just the time, right? I can say it anywhere that actually started ICANN from 8 years with a salary that is less than 30,000. I became a member of Association of Accounting Technician with a salary that is less than 30,000 naira in this Abuja in FCT. Right. I still move forward to skills level. It was even after my skills, I think after my skills level before I moved to real estate. So what are we not saying, that it is not the money? When you see the money, say, can you do? I can. Thank you so much, Mr. Razak. Thank you, sir.
All right, you're welcome, sir. So today we are going into today's topic. All right, and please, for the record, in our subsequent classes, we'll still be doing this recap. Okay, so I believe those who have attended before, they know that I'll definitely ask. And also, I'm telling you again, I'll still ask. I'll ask in my next class. It's not to undermine anyone. It's just for you to prepare yourself. At least when you have the sensitivity that someone will ask me in the next class, what I have read, it can also motivate you to read. All right? We are not here to discourage you. We are here to make you pass. Your pass is our own pass. If you don't pass, we are not passing. As you are preparing for ICANN, we too we are preparing for ICANN. All of us are coming to class. You are going to class. I'm going to class. You are online. I'm online. When you're writing your exam, we are praying. Some of us will be at the center, exam center hall, praying that these people are almost gone. They're almost done. When you come outside, welcome. How was it? How was this one? How was that one? All of us are into it. When your result is coming out, as your heart is beating, big, 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 our home too is beating, big, big, big. Will my students pass? Do you understand? So all of us, we are into it. Feel free to meet any of us. Any of us. If you have any questions, please meet us one-on-one. Send a DM. Send it to the group. Tag us. We are all available for you at any time. All right. So that is that. Now today, let's go into the business of the day. I think Mr. Ibrahim has started recording, right?
Yes, sir.
You started recording the class.
Yes, sir.
Yes.
Please go ahead.
Okay, so we can go into the business of the day. Now, today, we are starting with chapter 7, which has to do with the impact of differences in accounting policy, the impact of differences in accounting policy. All right? Now, sorry, let me share my screen, please.
Sorry, sir. I have something to say, sir.
Go ahead, sir, please.
So, please, I wanted to ask that if all the past video have been uploaded on YouTube, so that for us that we missed one or two classes, can just go and do a recap on it.
Mr. Ibrahim will answer that.
Yes, it has been uploaded, except yesterday's class.
Thank you, sir.
You're welcome.
All right. Now, looking at the impacts of differences in accounting policies. Now, why do we have accounting policy? Accounting policy is there to guide us, right? To tell us how to prepare and present our financial statement. So what is the impact on all the various accounting policies we have? Now, let's look at the term of fair presentation and IFRS compliance. So financial statements must be presented fairly, right? Your income statement, your financial position, your cash flow statement in line with IFRS. Now, when we're talking of fairness, what is truth? What is fairness? There's a difference between the two. The auditor will tell you, the accountant then the financial statement shows a true and fair view of the financial state of the company. What is that truth? What is that fairness? The true view is that it has you have prepared your financial statement and all items have been included in that financial statement. Nothing has been omitted. Nothing has been omitted. All financial information have been included in the preparation and presentation of the financial statement. What's the fairness? The fairness is that you have complied with all statutory regulations in the process of preparing the financial statement. So financial statements must be prepared fairly. What are these financial statements? Your income statement, your financial position, your cash flow. It must be prepared fairly in accordance with IFRS. If it is public sector accounts, in accordance with IFSAS. Now, it implies faithful representation of transactions. That's the truthfulness here now. Okay? Faithful representation of transactions using the proper definitions and recognition criteria. So where you are supposed to recognize a transaction as an asset, you have recognized it based on IFRS standard that this is an asset. If it is a liability, you have recognized it. All right? Financial asset, financial liability, revenue, expenses, all these have been recognized in accordance with the recognition criteria. Now, IAS 8 governs accounting policies, right? Auditors are expected to independently verify this fair presentation. And where the fair presentation cannot be ascertained, then the auditor will now qualify their audit opinion. They will qualify your report, your audit report. And what is that qualification? It shows that your financial statement does not show a true and fair view. That's qualification. And qualification can come in different names. I mean, it can be an except to, I mean, all those names. You can study it in your audit. It's not me and you. Today we focus on SBR. Now, causes of these differences. What can make you have a difference in your financial results? Number one, fair presentation allows you for a range of acceptable outcomes. Why? Because it doesn't have to be too strict. Okay? In Nigeria, we have, in the world, we have the rule-based and the principle-based. Now, the principle-based is either you comply or you explain, right? And that's what we have here. Now, IFRS itself gives you an opportunity to choose between range of acceptable outcomes. See, it is not just any outcome, acceptable outcomes. How? Sometimes you can use an alternative accounting policy, which means if I'm using straight line method and you're using reducing balance method, they can have a difference. If I'm using a judgment, a professional judgment, an estimate, you are using a professional judgment and estimate, there can be difference in the application. Do you understand? I can call in an estate valuer to tell me the value of my land or the value of our building. He will give me a value. I can call another person, and the person will give me a slightly acceptable, another slightly acceptable value. Do you understand? So all this can cause differences in the financial results. All right? I can call in someone to come and check my car, and the person will tell me, this is your car. Now this price that they sell out for market, or you feel sell out for this amount. I can call in another person, and the person will give me something similar. It might not be the exact one, but at least an acceptable outcome. Okay? So this variation may arise naturally and can be used, sometimes can be used to manipulate financial outcome. Sometimes it comes out naturally. It was not, sometimes it was not, what do you call it? Concocted. It's not a concussion. But sometimes you manipulate it yourself to make it look like that. And then when you manipulate it, it can affect your comparability. Okay? I hope I can proceed.
Yes, sir.
Maybe I'm not too fast.
Mm-hmm.
Okay. Now, the mechanism to reduce the problem, the mechanism. That is when you're having these differences, what has IFRS done to reduce the difference? Okay. Now we now have fewer policy options available compared to how we used to have it in the past. Before, if you like, you show this. If you like, you don't show this. For instance, under employee benefits, I think it's as 39 and it's as something. The new one is 39. I can't remember the old one. It can tell you that if you want to show your financial liability, and when you have what is this thing that the underwriters use, the insurance companies, what do they use? There's this name they have. So that profit or loss, right? They can tell you that you can show it if you like. And sometimes you don't need to show it. Now, that is an option. But right now, you must show it. There are some companies that they don't need to show their sustainability reporting, their CSR, corporate social responsibility. They don't need to have a report on it, environmental reporting. But now it is mandated on some companies. You must show it. Now, why do we have these things? Don't forget, we have the institutional investors who are always demanding. It's like they are almost demanding for management edge. They want to know everything going on. And because they are stronger and they are more in terms of investment, they have more investment. Because of that, you are forced to dance to their tunes. So every time they demand like that, we just review it. We patch it. Okay, we give it to them. These people are ever demanding. And because of that, we now have fewer policy options available. Okay, now IAS 8 provides rules for policy selection that you can select. IAS 1 says that you should disclose significant accounting policies. You should disclose critical judgments, estimates, and uncertainty sources. Where did you get your uncertainty sources from? All your uncertainties, your risk, your probabilities, where do you get them from? Show us the sources. Okay, now IFRS 13 now offers an improved guidance on fair value as well. Though these do not guarantee comparability, but they enhance transparency and understanding. We are not saying that all these new things will bring comparability. You should be able to compare your company with another one, but at least it shows transparency and understanding. Now, creative accounting and earnings management. For those of you who did CSMA, there's something called creative accounting there. Can anyone remind us? Can anyone remember what a creative accounting is? Anyone? Under 10 seconds, I'm counting 1 to 10. If no one responds, we move. Yes, creative accounting. So,
example is like window dressing.
sorry?
An example.
If you have an example, go ahead.
Window dressing, trying to make the account, trying to patch up the account to look like the desired outcome, something like that. I don't know how to put it in words.
To patch up an account to look like the desired output. Okay. Okay, go ahead, sir. I think someone is raising up his hand. Go ahead, please.
When financial statement is prepared in such a way that it's not showing Q and VRP to make it robust to the maybe to the management or the user of the financial statement, we call it window dressing.
That one is window dressing, don't you think so? I think that was window dressing, right? Am I right? I think that's window dressing.
Hello, sir.
Yes, sir.
Okay, so I think like creative accounting is just a way to present the financial record in a way that will be more favorable.
Should I accept that? Yes, go ahead, please.
Hello, sir. Good evening, sir.
Good evening, sir. Well done.
Yes. For me, I think creative accounting is simply the use of maybe different techniques, although it may be legally permitted, but not according to according to accounting standard, and it's a deliberate use of those techniques to achieve certain results, whether favorable or unfavorable. But definitely, it is most time favorable. So the bottom line is that they are using his use of technique to achieve certain result that is not standard compliant. Thank you, sir.
Okay. All right. So I'll take what everyone has said. Okay. Now, creative accounting is when an accountant is creative. Okay. It is legal, but it is against accounting standards. Do you understand? It is legal, but against accounting standards. There is a difference between legality and standard, though. Not all standards are incorporated into the Nigerian law. If it is not in the Nigerian law, but only in the standard, then you can be creative about it. All right. Now, so according to this material, it is a legal accounting practice that adheres to regulations, but deviates from the spirit of standards in order to achieve the desired results. So often it is not legal. I mean, it is not illegal, but yes, it can lead to fraudulent reporting. So techniques like that, we have window dressing. All right, we have window dressing. We have off-balance sheet financing. I can't remember one assignment I had then, and I had to go deep into this off-balance sheet financing. So window dressing has to do with sales made before year end, reversed after to inflate profit. Okay, so or another way is that expenses incurred in this year, and you don't want it to appear in this year. Let's say you purchase some items on credit, expenses incurred on credit. You don't want them to appear in this year, because once they appear in this year, they will reduce your profit. So you just move it to the following year. Let's say it happened on the 25th of December. You just assume that the transaction occurred in January so that you can increase your profit. Okay, so those are the things. Then also you have off balance sheet. That's one is when you keep an asset or a liability and you hide it. See, that off balance sheet is one of the craziest way of fraudulent reporting. It is very crazy. If you have time, just go through it. Like, you will have an asset and you will have a liability, and the law permits you to hide it. The law permits you not to present it in your financial statement. So you will be hiding your liability, you'll be hiding your asset, and they use it in lease. They use it in lease. So that is it. Then also, we have changing accounting policies and estimates. Yes, if you want to change your accounting policies and estimates, you can do that. All right. Then also we have capitalization expenses. Yes, you treat non-assets as assets. For instance, your brands, which is meant to be expense, you treat it as an asset. So something that is meant to be an expense, you treat it as an asset. We also have profit smoothing. And this one using artificial balances to even out profit across years. Something like that happened in my last financial statement and in one of my clients' reports. So what happened was the company deals in foreign exchange as well, and so because of that, there was one particular transaction account balance that was not balancing, and you know that this exchange rate palaver has thrown so many dumb accounts into problems. Dumb account holders, the accountants are into problem. So now, when I was discussing with the accountant said that he wants to make the closing balance of what he has, let's say in USD to Nigerian Naira. Let's say in USD, it's showing that the person has $20,000. And in Nigerian Naira, it's showing that the person has, let's say, 10,000 Naira. Now, when you convert $20,000, or no, let me even make it realistic. Let's say you have, your account is showing 10 million Naira, and the USD account is $20,000. When you convert $20,000 by 1,600 or 700, no, 1,600, 1,575 or 70 something. So let's just say 1,550. When you convert $20,000 to 1,550 by 1,550, what do you get in Naira? Yes,
31 million.
31 million, right? 31 million, and your balance in Naira is showing, when you convert it according to your own record, it's showing about 10 million. 31 million to 10 million is too wide. So the accountant was telling me that it will make the closing balance of that USD account, use it as the closing balance of the Naira account. The difference between that balance, you just add it. Okay, how do you add it like that? Do you understand now? Now, that is profit smoothing. All right, that's profit smoothing. You're trying to smoothen it out. All right, so that is it. Now, you can also have aggressive revenue recognition, booking revenue before it is truly earned, revenue that you have not earned. That is you disregarding your this concept, prudence concept, right? Is
Yes,
that
sir.
it? That is you disregarding your prudence concept that says that you should be very careful when you are realizing, when you are recording your revenue. Okay, well, all known liabilities should be recorded immediately. All right, so that's it. All these are methods of, yes, creative accounting. Now, we also have something called earnings management. That is, how do you manage your earnings? So this one is also a subset of creative accounting. All right, and what do you do here? You manipulate your earnings using the time and method changes. Different time and different method changes. So you manipulate your what's it called? Your earnings using that. Now, what are the techniques? It can be a deferred or accelerating expenses or revenue. Like I said, a deferred expense or accelerating revenue. Revenue that you have not earned. Today's date is 26. All right. So you are having a discussion on a contract with your with someone who is likely to give you a contract, with a prospective contractee on the 20th. Let's say the discussion started in December. Now, if you don't speed up that contract and get the contract in December, automatically you cannot record the revenue for 2024. So you will now speed it up and record the revenue in 2024. Then you can also have a deferred expense. Expenses that is now meant to be in that 2024, you defer it to 2025 so that the profit of 2024 can increase. That is it. Then also it can be in form of recognizing artificial balances to smooth profit, just like we said earlier. All right, so that's it. Now, at extremes, this can become criminal. At extreme, it can become criminal. All right, so that's it. Now, commercial pressures influencing ethics. Yeah, we have some pressures from left, right, and center. It can come from stock price expectation. Mr. Brahim understands stock price very well. Yes, If you want to know about CBN exchange, CBN rate, their, what do you call it? All those things. Meet Mr. Ibrahim. He's very good at that. And his last prediction about the last CBN meeting that was held, I can't remember what they called that. MD was
MPR.
MPR, yes. Yes, his prediction was valid, and that was the outcome actually. So his prediction was the actual. So if you need anything like that, please go to him. Now, there are pressure from stock price expectations. We also have performance linked pay. That is, they will pay you based on your performance. So it is not like there are some top managers and directors who do not only get a salary. They don't get salary only, right? They get bonuses, and these bonuses are linked to their performance. So we call it performance related bonus. All right. So the bonus will now be in form, it can be in form of share price, it can be in form of cash bonus, right? They set targets, and once they hit that target, yes, they get the bonus. It can be stock option. All right. And stock option can be in 3 different forms. That one, we are not going into it today. We also have job security. Yes. So because you want your job so badly, then you need to meet loan covenants. You need to minimize tax. Do you understand? All this can compromise your integrity of your financial reporting. You want to reduce your tax liability. You don't want to pay tax. So you are looking for ways to reduce your tax liability. You'll be looking for other incentives that are available to a taxpayer. You look for right of election, you don't get. You look for other capital allowances, you've exhausted them. You look for tax holidays. Tax holidays including pioneer. We don't call them pioneer status anymore, right? We call them priority businesses. You look for all those things. You know, starting from January, not now, but right now, as of today, they are still pioneer businesses, right? You look for all this just to reduce your tax liability. All of these are pressures, commercial pressures that can affect your ethics, that can compromise the integrity of your financial reporting. So when you see all these stock prices, then you need to be very careful. When they link your performance to your pay, that, for instance, now one of the targets I got in my office, I think it was around last year, so was to reduce all expenses by 40%. Now, when you have something like that if you reduce it, you will get this amount. That can force you to defer some of the expenses. You intentionally delay approval. Do you understand? So that's it. Are we together, please?
Yes, sir. Yes, sir.
Yeah. So these are the things that can put pressure on you. Now, when you look at, if you are aware of stock price, especially now that we have price volatility, where prices are changing, if you are expecting the price, it can make you go into insider dealings. So all these pressures, you need to avoid them. Now, revenue and asset recognition and abuse. Asset recognition abuse. So, of course, when you are window dressing, you book a sale late in the year and reverse the next year. Next year's sales, you put it in this current year. So some of these practices reduce profit intentionally. So it depends on what you want to do. If it is for you to reduce your profit, then you put the sales for this year, you put it in the next year. Do you understand? Sales for this year, you put it in the next year because you want to reduce your tax liability. Remember, the higher your income, the higher your tax liability. So you're doing all of this is to reduce your tax liability. And that is window dressing. Okay? You can write off assets now and then reuse them later with no future expense. Let me give you an example. You write an asset that you have used. Let's say you've used the lifespan, it's already at 0 period. So you write it off now that you have completed the lifespan of the asset. In the future, you bring back the asset, let's say the following year. You bring back the asset and start including it again. Now, no future expense. You're just using the asset. So you're using the asset to claim capital allowance. If there's any expense you incur on the asset, you claim it to reduce your expense as an allowable expense. All these are ways you recognize your asset and revenue abusively. Now, sometimes you create a liability or a provision, giving your own what do you call it, estimate, because you want to achieve something, because you want to reduce your tax liability. Then later on in the future, you now reverse it. All these are abuse. Now, we have the big bath accounting. And this one is when you're writing down everything bad in a poor performing year to make the future years appear better. What are we saying here? This year was very bad. Though. This one is bad. This one is not good. That one is not good. Now, you are saying that everything is bad in a poor performing year in order to make the future year appear better than next year. We will not have this problem again. So, of course, we should be able to achieve this one next year. Then next year, we will not have this problem as well. We should be able to achieve this in the next year. As you are saying that, you are trying to downplay the poor performance of this year and making the future year appear better. And this involves asset impairment and excessive provisioning. You are creating excessive provision for bad debt, provision for doubtful debt, all those provisions, provision for depreciation. Then your asset, you are subjecting your assets to impairment, even when they are not impaired. All those things are big bad accounting. So IFRS attempts to limit this behavior. Do you understand? Don't forget all these things, most of these things are permitted by law, but they will affect the ICANN standard, the IFRS standard. Okay? Now, IAS 37 and provisions abuse. Before IAS 37, provisions were used to manipulate profit by over or under reporting liabilities. Do you understand? You can over-report your liability or under-report your liability, depending on what you want to achieve. And I can tell you for free that there are some companies that the head of the company will come and meet you and tell you that this is what you should do. Yes. I've worked with, sorry? Okay. I've worked with someone before. The person is currently a House of Rep member. All right. Now, that person, then it will tell you how to reduce your tax liability. It will tell you how to cover your books, what to present to tax authority. Why? And all those people, because they study business admin, they believe they know accounting better than you. They'll tell you, I also did accounting now when I was studying business admin. They don't know that it's different. Right? What I will face from ICANN for doing those nonsense is different from what they will face. Now in House of Rep member. And those are the people we elected into the House of Rep. Me, I did not vote for him. If you want to go and check him, go and check my profile. Maybe you will see him there. So that's that. And all these people are there. Your company can approach you. Your CEO can approach you. Your, what's it called? Your CFO can approach you to do things like that. Even your CFO that is into ICANN, who knows the standard, will still tell you to do it. Do you understand? So these are the challenges you can face. Now, you over-provide or under-provide for liabilities. Then provisions were often based on management's intent, not objective evidence. Like I said, it is whatever you want that your intention will determine what you want to do. Okay? So that's it. Now, you can have different tactics for this. All right, you can have the common use, which is provisioning, restructuring, warranties, and redundancy. All of these are there. All right, so you need to recognize the large provisions during the bad years and reverse it later. That's the tactics they use. Now, the IS-37 prohibits restructuring provisions until a formal plan is committed. Okay, you restructure a provision whereby you will not reverse it. No, you don't want that until a formal plan is committed. Then also it requires remeasurement of that provision at each reporting period. And however, judgment and estimation still provide room for manipulation. All right, so these are the things we have. Now let's go to IFRS 15, where we have revenue from contracts with customers. Okay, now IFRS 15 replaced IAS 18 and IAS 11. Yes, all right. And IFRS 15, revenue is recognized to depict the transfer of promised goods or services to customers. Okay, the transfer of promised goods. So revenue is used to depict that transfer, the transfer fee. All right. Then in exchange for consideration. So I'll provide a service or I'll transfer a goods to you in exchange for consideration that the entity expects to be entitled to. So yes, a customer can be a party to that contract and all of those things. So when you want to recognize revenue, don't forget in our IFRS, we have four components: recognition, measurement, presentation, and what? Disclosure. All right. Now, the first step is to identify contracts with the customer. All right. So the first thing, how do we identify a contract? A contract can be a written contract, it can be an oral contract, and it can be an implied contract. What is an implied contract, if I may ask? Anyone, what is an implied contract? Implied contract, anyone? What is an implied contract? Oh, okay. So an implied contract is that contract that you didn't really say it, but by implication, it just happened. And of course, it is binding on all of you. All right, so that's it. Then it can be combined contracts. It can be a combined contract if it is negotiated as a single commercial package. Right? You can have a combined contract when you have 2 or 3 contracts and you negotiate them together. For instance, I want to buy shirts, I want to buy trousers, I want to buy shoes. I can negotiate the 3 of them. Okay, how much you go sell everything? I will ask for the individual prices, right? And after that, I would have gauged it in my head how much you will sell the 3 of them. Do you understand? So that's it. Then it can also be consideration. Consideration in one contract depends on the other. It can be a combined contract if the consideration of one depends on the other. And also if goods and services across contracts form a single performance obligation. All right. So I need you to do the exterior, I need you to do the interior, and I also need you to do the finishing, let's say the outside or something. So all those things, yes. And contracts must meet the criteria, that is, it must be approved by all the parties. The right and payment terms are identified, the commercial substance is identified, and there's probability that the entity will collect consideration. If these are not met, then any payment received is a liability, not a revenue. When you don't have all these elements, these criteria agreed upon, if you receive any money from that contractee, it is a liability, not a revenue. So that's that. Then also you need to identify the performance obligations. Okay. And a performance obligation is a promise to transfer a goods or service, a distinct good or service, or a series of distinct goods or services with similar transfer pattern. Okay, so it is different if the customer can benefit independently and it is separately identifiable within the contract. If not different, then combine with other goods and services until a distinct bundle is formed. All of this, they are there, please. You can read further. So how do you determine the transaction price? Okay, it can be an amount expected in exchange for the goods. It can be a variable consideration, all right? Which can, when we say variable consideration, it can have a discount, it can have a rebate, it can have a bonus, it can have tax, all right? Then it can be a future payment, a deferred payment. Then if it is a deferred payment and you're not receiving it in that same year, then you need to consider the time value of money. You need to discount it. Get your, what do you call this? Discounting factor. Okay, so that is it. Then also, you need to look at the customer risk, customer's credit risk. Will the customer be able to pay? Will the customer not be able to pay? So that is that. Now, also transaction price must reflect customary practices and probable consideration. All these are there. Then also you allocate prices, okay? Allocate prices based on standalone selling price. It can be a discount allocation selling price. And when you're recognizing your revenue, you only recognize your revenue when or as performance obligations are satisfied. When it has been satisfied or when it is being satisfied, it's still in progress, work in progress, right? So that is what we have there. Now, the performance obligation is satisfied when control of the asset is transferred to the customer. So that's it. Now, we have the timing of revenue recognition. Yeah, we've discussed this before. Okay, so you recognize your revenue over time, where customer simultaneously receives and consumes the benefit, or where you have created the performance, or where there's no alternative use to the entity, and it is enforceable by law that you get paid. That's when you recognize your revenue. Okay, so that's that. And now, how do you measure revenue? You can measure revenue based on output method. You can use input method as well. Okay, for output method, it is based on value of customers, milestones, units delivered, time lapsed, hours worked. No, hours worked is input. Okay, and may not always be observed as cost effective. But the input base is your effort. Yes, the cost you have incurred, the labor hours or hours worked. Okay, so that's it. And this must be faithfully represented. Okay, so that's what we have here. Now, the additional note. The additional note here is that revenue is not invoicing. Someone gave you an invoice, does not mean the person gave you revenue or you have earned from the person.
Yeah.
All right, so that's it. So input method under IFRS 15. Okay, we've discussed this before. I think we can move out of this now. Factors affecting transaction price, we discussed that. So they came back in form of a full, what do you call it? A full note so that you can understand them better. Do we have any questions so far? Do we have any question? Any question, any addition, any subtraction?
Hello, sir.
Yes, sir. Go ahead, sir.
On that area of how to measure revenue, please, can you?
I'm not sure I heard that. On that what?
How to measure the revenue?
Okay.
Measure input and output. I think you still mentioned some other points.
I heard that. The input and output method, right?
Yes, I think
Okay.
there is other.
Okay, so for input and output method, we will be looking at, let me just come to, where is this asking? So for input and output method, right? We'll be looking at, in your output method, what are the things you did? Do you understand? What are the things you've done as output? What are the things you did? What's the quantity of units you have delivered? What did you sell? Okay, that is output. What have you done? And input we have to be what is the hours you have worked? What is the cost you have incurred on that work? Do we understand, please? So what is the cost you have incurred? What is the hours worked? That is what we have on input and output.
Thank you.
Yes, sir. Yes, anyone else? What else do we have? Anyone else? I need us to ask questions. Yes, anyone else? So should I assume there's no question again? And shall we move on?
Yes.
Yes, sir. Let's proceed.
So can I ask my own questions?
Yes.
Can I ask my own questions?
Yes, sir.
Eh?
Yes, sir. You can ask.
Okay. So let me look at some of the things we've done before. And I'm not asking you to do verbatim treatment of what we have. No, we've not really done anything, right? We are just trying to introduce ourselves to what we have here. All right. So we've not really done anything. But okay. So let's look at where we have contract. How does a contract really work? How does a contract really work? Yes, how does a contract really work? What are the things you need to know? What are the things you do under contract?
Under contract, you need to recognize the revenue with the level of the percentage of the work completed.
Uh-huh. Is that all? Now, I'm not talking about what we did today. Like generally, what do you understand in contract? We've not completed this topic.
Yeah, okay, there must be an agreement between the party involved.
We've not completed this topic. So I just want us to look at, yes, an agreement. What is a contract itself? Yes, what is a contract?
Sorry. To me, I think a contract is an agreement between two parties where one is given a specific task to perform
Okay.
on behalf of the other person, and there will be a monetary value after the completion of the task.
Okay.
Yes, contract is an agreement between two parties that is enforceable by law.
Okay. All right. Yes, you are right. Contract is like that. Now, you know that when you are dealing with contract in your FR or even in your CR, right? You know that there are some, for instance, now, how do you recognize revenue in contract? You know, there is a way you do that, and also there is this they'll tell you there is one of input method. Apart from all this input and output method, there is one of value. and another one is based on cost, something like that. Right? So all these are to be included in your thoughts, in your knowledge of contracts. Now, the contracts you'll be doing in, okay, I think you've dodged contract already now. The major contract you have to do, you've done it in PM. Then you can have another element of contract like what we are discussing here, can also have it in your SDR. But that's that for now. Okay. So I think I want to take another standard now. While before I take another standard, maybe I should just complete this particular one that we are almost done with. And I think it's something we can read. It's something we can read actually. So let's just make it a question and answer session. Right? Now we have principal and agent consideration. So who is a principal? Who is an agent? Who is the principal? Who is an agent? Till tomorrow, we are still using this agency theory, especially in schools. Till tomorrow, we still use agency theory. Who is a principal? Who is an agent? Yes, who is a principal? Who is an agent? Yes.
So the principal basically is someone that is assigning a right to another person to work on behalf of him or to work for him. While agency is a party that is working on behalf of a principal or on behalf of someone else to get a monetary value.
Okay. Now, a principal is the owner of the business. An agent is someone who is working for the principal. Right? Now, principal and agency. Okay? Principal and agency is whereby they will call it an agency relationship, principal agency relationship, when or if an entity or someone controls another person. All right. Now, someone can take responsibility of whatever happened. Now, an entity is a principal. If that entity controls a good or service before transferring it to the customer. All right. So that's a principal. Now, it is the responsibility of a principal for fulfilling the performance obligation, either directly or by engaging another party. The other party you are engaging is an agent. Please help me with this. Do you understand? So that's it. Now, this principal will recognize the gross revenue, the full amount billed to the customer. All right. So that's it. Now, merely obtaining a legal title before transferring an item to the customer does not automatically make the entity the principal. Okay, so that's not it. But here we are looking at something like more than just you getting a title and transferring. No, we are not looking at that. All right. Now, an agent is someone whose performance obligation is to arrange for goods or services provided by another party, which is the principal. All right. Now, we have all of this. And also an agent can be someone who recognizes revenue only for the commission fee received. So the only thing an agent will recognize is the commission he has received. Do you understand? So that is that. I think before the end of today, I should be able to cover the next chapter. I should be able to complete the next chapter. But let's see, let's move on first. Now, indicators of being an agent. What are the indicators? What are the things that once you see them, then you know that this person is an agent? All right. So what are those things you see to say that this person is an agent or this person is a principal? So for an agent now, an agent, if another party is responsible for fulfilling the contract, that is, if anything happens, another party will fulfill the contract. That is an agent. All right. Then also, there is no inventory risk borne by that entity. As an agent, if anything happens to your goods that you have kept with me, it's not my fault now. It is until I sign it. Until I sell it, and there's no promise between us. I am not this del credit, except you are paying me del credit commission. If you're not paying me del credit commission, it means any of your goods, I can return them, except you are paying me for selling everything off and taking the risk that even if I don't sell them off, I can take up the risk and pay you. All right. So aside that, these are you on your own, right? So that's it. Now, also, if I don't have control over the price, if I don't have control over the price, then I am just an agent. And also, if constitution is in the form of commission, if what I receive is commission, what I receive from everything is commission only, okay, then that means I am an agent. All this will make you recognize who an agent is. Shall we proceed, please?
Yes.
Okay. Now, I don't have any exposure to credit risk. That is, if my customers don't pay, I don't have any issue. Now, there's this thing I would want us to touch quickly: sale with a return, with a right of return. Okay. And here, a customer may purchase a product with the right to return it. All right. So, yes, you can sell something to a customer and give them the right to return it as well. Okay. So, that is a sale with the right to return. Now, it can be in form of revenue, all right? And when there is revenue, in this case, you recognize your revenue, you recognize only the portion that is expected not to be returned. Okay? So only the portion that is expected not to be returned. All right? Then also the refund liability for the expected returns, you record it as a liability. All right? Then also the return asset, an asset for the right to recover the goods from the customer. All right, and the corresponding reduction in the cost of sales. All right, so that's it. Now, please hold on a second. Hold on a second, please. 1 second. Sorry about that, please. Yeah. So we are talking of sales with a right to return, right? So you sold an item, but you give them the right to return it in case they are unable to sell. Then that is to an agent, of course. Then also you can have a repurchase agreement whereby you have a contract that you sell an asset, but you also have the option of buying back the asset. For instance, I can sell my car to you because I need money. And also we draft a contract that if I have money later, I can come and buy the car again. I can come to repurchase the car from you. So that is a repurchase. Now, if repurchase occurs, then there is no control. No control is transferred to the customer. It means that the control of that vehicle is not in your hands. It's still my car. I don't know if you understand. So it is still my car. I'm not transferring the control of the car to you. All right? So that's it. Now, in a case like this, it is treated as financing arrangement, not a sale. It's a financing arrangement, not a sale. And the accounting treatment will be for you to recognize that the financial liability and not revenue, you that you are selling, that you are collecting the money. It is not a revenue. And you continue to recognize the asset in your account. And the difference between the sale and repurchase price is treated as interest expense. Do we have any question on that? You can also have bill and hold sales. Okay, and this one occurs when goods are billed to a customer but are held by the seller at the customer's request. That is, okay, I want to buy this thing. So please take the money. When I have the time, I'll come and collect the item. For instance, you can give don't give someone who is doing handiwork that take my money, you do cake for me on the 30th of next month. Now you have paid. If you have paid, you that you have paid, be careful. Oh. But to that person who has received the money, the person who wants to bake the cake for you. All right, that money is not a revenue yet. Do you understand? You've billed the person and you are holding the item at the customer's request. Right? Yes, revenue can be recognized before delivery if these conditions are met. What are the conditions? If there's a reason for the arrangement, if the reason for the arrangement is substantive, that is, the reason for that is because the customer has no storage space, or I don't want to spend this money, something like that. Then also where the product is separately identified as belonging to the customer. And also when the product is ready for delivery, you can recognize it as revenue. When the seller cannot use that asset again, that cake you have baked, probably you've written the name of whatever on it. Even if it's an icing sugar, you can clear it. That one is not the issue. But if the product has been prepared and cannot be used for any other thing again, then you can recognize the revenue. So that is that. Now we also have consignment sales. Yes, consignment sales is when you send goods to another party to sell to the end customer. Okay. Yes, I sent the goods to an agent. Let's say I'm producing here, I'm sending it to Alaba market so that they can sell for me. That is consignment sales. And here, sellers, me, the seller, I retain the control of the product until it is sold. And I can ask you to bring back my goods. The dealer does not have any unconditional obligation to pay for the product. All right. So that is what we have under that. Do we have any question? Do we have any question before we go into the next chapter? Do you have any question? So let's go into the next chapter before under 30 minutes. I think we should be able to complete the next chapter under 30 minutes. Really. So the next chapter talks about PPE, Ias 16. What chapter will that be? What's the next chapter, please? Is anyone even
that should be
huh?
That should be 9. 8 is IFRS 15.
9, thank you. Chapter 9. No, someone says chapter 8. No, it's chapter 9. No, you're sorry. It's chapter 9. You're not following us like Twitter. So non-current assets and non-financial liabilities. Non-current assets and non-financial liabilities is what you have here. Now, yes, PPE. What do we have under PPE? What do we understand in PPE? Yes, PPE. What do we have?
Property, plant, and equipment.
I know. What is under property, plant, and equipment?
And they are non-current assets.
I know they are not current assets. They're just taking us back, right? Yes, we know too. Have you done PPE before? What can you tell us about PPE? Yes, what do we have under PPE? Yes, what do we have
Okay.
under PPE? Go ahead, please.
Okay, so like I said, it is property, plant, and equipment, and they are tangible assets that are held for use in the course of production of the business. Like they are used in the production or service in the business,
Okay.
and they are expected to last for more than a year.
Okay.
Also used for administrative purpose.
Sorry, someone is saying something.
As I said, it's also used for administrative purpose.
Okay. So you know that there is a difference between PPE, investment property, and which other one? Which other? What's the difference between PPE and investment property?
An asset held for resale.
Investment, they are using it to generate income.
For capital appreciation. That is investment.
Thank you, Jare. See, that's the word I'm actually expecting.
Why the PP is for the and being an owner occupy or used for the purpose of the business.
Okay. So that's it. That's the exact thing I was actually waiting for. Okay. So PPE it can be for administrative purpose, but of course for the business purpose, right? But when we are talking of investment property is for capital, is for two things. Number one, capital appreciation, right? And number two, to do what?
To rent, for rent.
To generate rent, to get rental income. Once those two things are there, then it is an investment income. Does that make a sense?
Yes, sir.
Once you have those two things there, then it is an investment income. All right? So that's it. Now, we also have what else? What else do we have? What are the things? We have cost method for PP, right? We also have revaluation method, right? Now, one of the things I see under this PP is that asset register. I'm not sure asset register is in your course, but I've seen it for taxation students. Yeah. Now, asset register. Now, when you are dealing with asset register, there are some things that must be in your asset register. All your assets will be there. There are some assets, only your PPE will be in your asset register. Am I right?
Yes, sir.
Only your PPE will be in your asset register. your non-current assets, I mean your non-current assets, other non-current assets like what? The intangible assets will not be in your asset register. Am I right?
Yes.
Now, those ones that will be in your asset register, how do you treat them? How do you record them? If I ask you now, can any of you prepare an asset register? Can you prepare an asset register? Do you remember an asset register? What are the elements of an asset register? What are the things you see in an asset register?
The date of acquisition of the asset must be there. The purchase price, the useful life of the assets,
Okay. So let's just
the method of depreciation used for the asset.
straight line method, all those things. Okay, fine. So now let's come to PPE without wasting our time. Now, for PPE, property, plant, and equipment, they are all tangible assets, right? And they are held for production or supply of goods and services, right? PPE can also be held for rentals to others, and also it can be for administrative purpose. And of course, they're expected to spend more than 1 year with us in our office, right? Now, the bearer plant, which is also classified as PPE. Bearer plant is used in production of agricultural produce. Okay? And they're expected to get produce for multiple periods and not intended to be sold, except as scrap. There's one other thing I'm trying to remember. PPE, investment income, and there's one other thing. Asset held for sale.
Asset held for sale, FRS 5.
Yeah. So that's it. Now, initial recognition of your PPE. All right, you recognize your PPE if, number one, there's future economic benefit, there's probability that future economic benefit will flow into the reporting entity, right? And the cost of that asset can be measured reliably. All right, and also significant parts must be depreciated separately if it is material. So that's that. Now, the initial measurement, that is for recognition. How do you measure it? When you're measuring the cost of your asset, you look at the cost of the asset, the purchase price, less any discounts or rebates, add any non-refundable tax, less a refundable tax. Do you know what a refundable and non-refundable tax is? Do you know what a refundable and non-refundable tax is? What is a refundable tax? Example, what's the refundable tax?
Hello, sir.
Yes, sir, go ahead.
You say refundable, I didn't hear.
Yes, refundable tax. Do you have any idea what a refundable tax is?
No.
Huh? All right, so that's it. Now, a refundable tax is a tax that you get back. A non-refundable tax is a tax that you don't get back. Okay, so that is it. Whether refundable or non-refundable. The refundable taxes, you don't need to add it to your cost of purchase. But the non-refundable tax means you have paid and you not get it back. And that one, that non-refundable tax, you add it. Now, your initial price, purchase price is there, the direct cost of carrying the asset, transporting the asset, cost of installation, delivery, and all of that. All of them are there. Then dismantling the asset and restoring the place to how it originally was is also a cost for your asset. Now, exchange of assets. So assets are measured at fair value unless the exchange lacks commercial substance. Okay? Yes, you measure them at fair value. Then fair value, that is unless the asset lacks commercial substance, or you cannot measure the fair value. So you have to use fair value of asset given up unless the one received is more clearly evident. Okay, so usually you have to use fair value for an asset. And if it cannot be measured, you use the carrying amount. Subsequent expenditure on an asset can be capitalized if it enhances performance or extends the life or replaces a part. That's when you can capitalize a subsequent expenditure on an asset. For instance, on building, what do you capitalize? Building improvement. If that improvement can give you more space, then that you can capitalize it. What do we call overhauling? When you overhaul a generator, it means you are increasing the lifespan. You are increasing capacity. Sorry? What do you say, please?
I said the lifespan.
Yes, when you are increasing, if that expense will increase the lifespan of that generator, and if it will increase the efficiency of the generator. Right, that's it. Now, also, you expense it if it's just a repair and maintenance. Major inspection is that they are capitalized if criteria are met and recognize prior inspection costs. So after your initial measurement, the subsequent measurement can be cost model, which is the historical cost, the cost of purchase minus depreciation, right? Or accumulated depreciation. Then you can have a revaluation method whereby the fair value at revaluation date minus depreciation for that year and less impairment, if any. Then also, you should note that if you are using cost model for your motor vehicle, you also to use cost model for plant and machinery, furniture and fittings. You are using the same thing for all of them. And the key depreciation terms is depreciation is there, depreciable amount, residual value, useful life, carrying amount, all those things, please. You are expected to know them. Then the evaluation impact, it can increase in value, it can decrease in value. So if revaluation increases the value of the asset, all right, so you credit it, you put it in the OCI, evaluation surplus, unless it reverses a prior decrease in the profit and loss account. Then if it is reduced, if it reduces the value of your asset, you put it in your P&L account, all right, so that's it. Now your evaluation surplus realization may be transferred to retained earnings, of course. All right. So IAS 16 judgment areas is that you have to capitalize your cost. You treat subsequent expenditure if it is to be expensed or capitalized. Then componentization of depreciation. You have different components for depreciation. We don't have enough time tonight. I would have shown us one assets register. I don't know if we still have enough time before 8 o'clock. Maybe I'll show us an asset register. A typical asset register, just like what that man said earlier. I don't know your name, but that's because I'm not looking at the Google Meet interface. So I'm looking at the material itself. So that's why I can't recognize who spoke earlier. And also you choose your depreciation method, estimate your useful life and residual value of the asset, and also select the measurement model, whether you're using cost or evaluation. Then also you classify the assets into appropriate classes. Now, investment property. Investment property is a land or a building that is held for rental income or for capital acquisition or for both. Okay, so it does not include property held under IAS 16 for production, used for production or supply. No, it is not used for administrative purpose, and it is not sold in the ordinary course of business, which is inventory. And it is not held for sale. So it is not held for sale, not in the ordinary course of business. Because if it is held in the ordinary course of business, that is inventory. All right, so that's it. And also, we recognize it also, the same recognition criteria for IS 16 and IS, what's it called? IS 40. There's probability that future economic benefit is flowing to the entity and the cost can be measured reliably. All right. For initial measurement as well, the same thing, and all the direct costs, purchase price, and directly attributable costs. For leased investment property, you have to follow IFRS 16. When we get there, we'll treat that. Now, subsequent measurement is based on fair value as well, and also on cost model. The same thing we have said earlier. Then transfer, fair value, cost model, judgment. Judgment is also here. You can go through the judgment. And for investment, for intangible assets, all right? So they are identifiable non-monetary assets without physical substance. They are assets, but you cannot see them, you can't touch them, you can't feel them. You can't touch them, you can't see them, but you can feel them, all right? So they are identifiable and they are controlled by the entity, and yes, economic benefit will flow into the entity when you sell them. Yes, you know, you cannot quantify your inherent goodwill or your intangible assets. So purchase goodwill can be presented in the financial position, but not inherent goodwill. All right. So those are the things. Then also we recognize this future economic benefit, all the recognition criteria that we have mentioned earlier. Yes, they are there. The initial measurement, of course, at cost, purchase price, that is when you purchase it. If you acquire it through exchange, through government grants, through business combination, if it is internally generated one, which of course there is a strict rule for that. Okay, and the subsequent measurement is that we capitalize only the extent of what we capitalize, while the others are to be expensed. Okay, so that is that. Internally generated intangibles are not recognized. I've said that before, right? The research and development, you do not recognize research phase. At research phase, you do not recognize it. You expense everything. Not recognizing it means not putting it in a financial position. Okay, but once you started developing, then you can recognize it as an asset. So business combination in process R&D, all right, that is work in progress. So yes, you can recognize that work in progress when you've gotten to a certainty that it will boost, and yes, it will manifest. The project will be developed, all right, and yes, you will sell the project. So once all those conditions are met, please, you can recognize it. And of course, you can recognize it on cost model and evaluation model when there is an active market for it. That's for your intangible assets. Now, all assets in a class must be on the same model, right? Now, in your PPE, your assets depreciate. All right. But under intangible assets, we have amortization. There is no depreciation here. We have amortization, right? In the amortization, the same way as depreciation is also what we have. All right. Now, what else do we have? Okay, let me open this. Now, we also have the IS 38 judgment. Please, you can look into that. It's a summary of everything. Then also we look at IS 37. I hope people are still there with me, or am I the only one here?
You are with you, sir.
Right here.
Yeah, I know you are with me. I'm just asking if I'm the only one here. I'm trying to bring out an assets register that we can use. Okay, it is already open. Sorry, hold on a second. Yeah, assets register. So I have the assets register. Once we are done with this, we'll go into the asset register. Now, IS 37 talks about provisions, contingent liabilities, and contingent assets, right? A provision is a liability of uncertain timing or amount, the provision. So you don't know the amount, you're not sure of the amount, you're not sure of the timing. And of course, the liability is an obligation from past events, and it is expected that there will be future economic outflow. You will pay the future. Of course, there's an obligation event that has created that. So you recognize your provision when there is a present legal or constructive obligation from past events. If something has happened in the past that warrants you to pay, yes, you recognize it. Okay, and when there is a probability that there will be an outflow, that is, you must make settlement, and you have a reliable estimate. If all these are met, then you can recognize it. But if any of these conditions, any of them, not only one, not all of them, or if only one is not met, then it is not a provision. But if all of them, the three of them are met, then it becomes a provision. So measurement of provision is that you measure your provision based on best estimates. All right. Then you use discounting factor as well. You can use a pre-tax rate, pre-tax cost of capital, discounting factor. Then also you can review it annually, and you can change your provision. You can have an increase in provision or decrease. Then also there is room for reimbursement. So for reimbursement, now you recognize reimbursement, an asset for reimbursement, only if the receipt is virtually certain. This person will refund the money only if it is virtually certain. That's when you recognize as reimbursement. Then also there is no offsetting with the provision in the terms of financial provision. Financial position, right? That's that. So what do we use provisions for? All right, we use it for specific expenditure that are originally recognized. Excess provision can be reversed, and insufficient provision can have additional provision added to it. Is anyone there? Is anyone there, please?
Yes, sir.
Okay. Now, where we have specific guidance, we can have a one-off contract. And in a one-off contract, you can have a one-off contract or one-ross contract when the unavoidable cost is greater than the benefit. Okay, when the cost is greater than the benefit, you call it an unavoidable cost. Okay, so that is that. And another thing is that sorry, 1 second. Yes, another thing is you recognize a provision for the excess of cost over benefit if it is a one-off contract. But if it is a future operating loss, then you don't recognize provision as they relate to the future, not past obligation. Now, restructuring. You can restructure provision if a detailed formal restructuring plan exists. Remember we said it earlier, all those window dressing and restructuring, you can use them to evade tax. You can use them to cover your account, to do creative accounting, right? So yes, you can only restructure when there is a plan, when there is a formal restructuring plan and there is a valid expectation. So that is that. Now, what else? Future repairs and overhauling is also there. Recognize if there is an obligation. Contingent liabilities and assets is when there is possible obligation. All right, that's contingency, contingent liability. When there is possible obligation or when there will be a possible asset. Any other thing? Yeah, you look at the summary table here. If there's anything you don't understand, please reach out to me. Do we have any questions so far? Any questions so far?
Hello, sir.
Go ahead, sir.
So what of a situation whereby a person acquire a property and that property is used for the maybe business purpose and part of it is used for rental? How are we going to account for such a?
I did not get that.
What I'm saying is that the IS 16 and the 40 somehow relate, somehow. I said that when someone acquire a property and the property is used for the business purpose and part of it is used for the rental purpose, how are we going to
Okay.
account?
So one of them is used for business purpose, and part is used for rental purpose, right? Now that one is still under IS 16 now. Have you forgotten the definition of IS 16? You can rent. You can rent out part of your assets, and it's still under IS 16. We discussed it under the definition in our material. Don't worry. Just reach out to the admin. Once you get the material, you will see everything there.
Okay. Okay.
Any other question? Any other question? Okay, so within a very short period, let me quickly show us this asset register. And that's because we mentioned asset register earlier. Okay, can you see my screen now? Can someone see my screen?
Yes, sir.
Okay, so this is the schedule. All right, this is the schedule. Now, this is the cost. At cost, these are the assets, land and building, land separated from the building, because land will depreciate, but building will not depreciate, right? And this one is not even a building, it is building improvement. So you can see that building improvement is an asset, right? You have motor vehicle, you have plant and machinery, you have furniture and fittings, equipment, computer equipment, and this. All right. Now, you see the figures here, the costs are set when you purchase them. If you are using cost method, this cost here will be your historical cost as at when you purchased it. Or if you are using a net book value, it means that your net book value for 1 year, your closing balance for 1 year is your opening balance for the second year, right? Am I right?
Yes.
Okay. So that
Yes, sir.
is that. Now, your cost, the cost of the asset is here. If there was any opening balance adjustment, probably from the previous audit, you have it here. Now, if there was any asset purchased during the year, for instance, now this one, if you go to building improvement, where is this building improvement? You look at the cost. This is it. All right. Now, that which was purchased during the year, there was nothing at the beginning, but this was purchased during the year under building improvement. You can see. So this value here is what you have here. You can see this one is automated, equal to what you have there. Right? Now, there was no new motor vehicle purchased. There was no new plant and machinery purchased. This one is from my client, though, and I'm sure the name of my client is ABC Limited. So go to CAC to check who is using ABC Limited. Then also, we have furniture and fittings was purchased during the year. Office equipment was purchased. Computer equipment was purchased. And this. Now, if there was any disposal during the year, this is the disposal account. All right. So that's it. Now, this is the disposal. So you add up whatever you have. Balance at the beginning plus additions minus disposal will give you the closing balance at the end of the year as at cost. Now you come to depreciation as well. Depreciation at the beginning, that's your accumulated depreciation, right? Yes or yes?
Yes. Yeah.
Accumulated depreciation. Then also depreciation for the year. If there was any adjustment from auditors, this is where you have it, right? Now, if there is depreciation for the year, this is it. Now, this asset that was disposed, an asset disposed can have a depreciation. This one does not have, that's why it's not reflecting here, right? I can't even remember what happened. So this one, any disposal for this item, then the depreciation as well, up to the point of disposal has to be removed. Then this is your closing balance for depreciation, right? After this, your carrying amounts now will be cost minus depreciation at the end of the year, and this is what you have. All right, so this is 14, F14 minus F21. F21. Cost minus depreciation will give you this. Do you understand? The same thing to this, and this. So this is your net book value as at 31st December 2023. Now, what is this opening balance? Opening balance is your opening here, H9, opening minus opening here. So that is what you have here. Your net book value, your assets must have all of this. This is what we have for today. We continue from here. We do the next. Wait, we should have a question. The problem is that we may not have a standalone question on IS 40, IS 16, and the rest of them. But please, all of you, look into these topics. Check the Pathfinder from 2014 to 2024 to 2025 May Diet. If there's any question that we can solve on these topics, please state them, put them on the group before the next class. All right, so that we can compile all of them together and treat them in our next class. All right. So thank you very much for tonight. I'll see you all in our next class. Good night, everyone.
Thank you. Thank you.
All right,
Good
sir.
night.
Thank you so much, sir. Thank you so much, Mr. Razak.
You're welcome, sir. Good night, everyone.
Sorry, sir. Hello, sir.
Yes, sir.
Please, we need the updated notes.
You will get it, sir.
Yeah, so we need the updated note. Thank you.
The center will reach out to the center. Mr. Ibrahim is here. He will solve that.
Okay.
All right, sir. You will get it. Thank you. Good night, everyone.
All right. Thank you so much, sir, Mr. Razak. Thank you, sir.
All right, sir. Okay.
Yes, sir.